Yeah, thanks, Matt. To your point, you have a lot of bottoming action in these bottom dwellers, as Frank referred to them as. And I think that it's worth illustrating what it might look like, what you could do if you wanted to bet on more upside. If you want to bank on the bottom, what's a strategy in the options market you could use that makes sense in this environment? I do like the breakout attempt today in IWM. And if you believe it sticks, you will see more upside. Okay. Because if you don't see more upside, it wasn't a legit breakout and it's going to fail. I think it's a decent attempt, assuming it closes, strong where it's at. So how do you play it? One of the other dynamics you're seeing play out today is implied volatility is getting smoked. It is as if all of the anxiety surrounding the debt ceiling is done now. Okay, I passed it. So any anxiety around there, you're seeing a sigh of relief today. And then the jobs report, I think, is taking some of the wind out of the sails of imminent recession and such. So some of those concerns are being laid to rest, at least in the short term. And you're certainly seeing it with option pricing, where the VIX is the lowest it's been since, well, wasn't this low last year at all. Might even be almost the lowest since like 2020. It's about the lowest it's been. So out of the money puts just got a whole lot cheaper, which makes it tricky. You can still sell puts, you're just not going to get paid as much. So what I like is more of a directional long option play here to take advantage of the cheap nature of option pricing and to give me a little bit more upside. Because if we do see legs to the upside, I want a strategy that's going to capitalize. You'll take full advantage of it. So $180 stock, okay? I could come in here and I could just say, well, let's go to July, 49 days out, okay? And let me just buy the 180 call. You just want to buy a call option, okay? You could do that. I don't think you're crazy. It's going to cost you $5.70. So what I like to do to make the trade cheaper, to enhance the leverage, which means you're going to get a juicier ROI versus a small move in the stock, okay? And just make it overall an easier trade to manage. The thing with long calls is they win big, but they lose big. And so it's harder to stay in because your P&L fluctuates quite a bit because you're picking up quite a bit of exposure. So you can tamp down on that a little bit, make it a more manageable position to let the market have time to work itself out by creating a spread, okay? So I want to build a bull call spread, and all it entails is selling a higher strike call against the one you purchased. So we bought the 180. So what I'm going to do is sell a higher strike call against it. And one of the questions would be, well, which call do you sell? Which higher strike price do you choose? There's not a right answer. Okay, there's not a right answer, but two techniques you can use. One is try to get a net delta around 25. So if I'm buying a 52, 53 delta, to get a net of 25, 53, let's subtract 25, I'd sell about a 28 delta against it, such that the net position is still long 25 deltas. Well, that would equate to me selling the 188. So if I sold the 188, that would create an $8 spread with a 25 net delta, which is pretty good exposure. And that's cutting the cost down to 365. I like that as a technique for which strike to sell against it. Another technique I like is go look at the chart. When you sell a higher strike call against the one you purchased, you're capping your gain at that level. Might make sense to cap the gain at what you think is the target, where you think IWM could go if the breakout's legit. And for me, the main reference point on the daily is the old support zone that we stood at before the whole thing broke down with regional banks and the Silicon Valley bank fiasco a couple of months ago. And it just so happens, it's actually 186. It's actually 186. So I could see someone say, no, I want to do a 180, 186 bull call spread. I think that would work fine as well. In the case of 188, I actually kind of like the 188. Okay. I'm fine with that as an $8 wide. I don't know that I have to do a $10 wide spread. Okay. You could. You could. So dealer's choice on that, as Greg likes to say, I think $6, $8, $10 spread, any one of those works. I just like the fact that I'm cutting my cost a couple $100. It's easier for me to manage a trade that's $365 than $565. And when you look at the potential upside, let's analyze this here. Well, I like to play with IWM, so got a lot of stuff going there. It's a pretty bad. This one's actually pretty balanced risk reward. Risking 366 to make 434, so can make 100% potential return, and that's something you can manipulate as well. If you say, I'm so greedy, 100% return, I don't know that that's enough for me. Oh, fine. I mean, you can make it. You can make it more upside. It's just you're going to be selling a call that's even higher than 188. Like you're asking the stock to get up further there, right? You could also change the lower strike, but I don't want to get too crazy here. I actually think it's good. I think it's fine. I think you got plenty of upside there at the 188. So what I would do is I would decide from a risk management perspective, if it doesn't work, if we crumble back down here, you don't have to risk the entire $368. Like you could put a stop loss somewhere. You could come into the 9 and say, hey, if it breaks back below the 9, forget it. I want out. It's 176 and change. Well, I got to stop at 170. Let's just say even 176. Your downside risk is about $110. Okay, so then it's more like you're risking 110 to make 400. If you want to feel a little bit better about that. I don't have a strong opinion on where you put the stop here. There have been many times where IWM got messy after trying to break out. I'm giving this the benefit of the doubt. And indeed, the longer I talk, the better this candle looks. So I should just keep talking, Frank, for the next to talk it into the close, I feel like.
Do it.
But I don't know. I think if it breaks the 9, I think you can definitively say this breakout at 10th failed. So I actually like that spot for the stop loss. But to sum up, there you go. $8 wide bull call spread, directional way, play the low IV, play the breakout, give it a chance. I like this as an aggressive directional play for breakouts like IWM. And hopefully we see some other opportunities like the IWM and materials and some of those economically sensitive areas in the coming weeks. Yeah. So that's a strategy you can play with, I think.